an investment report on NIO. The argument is that at $546, it's a strong buy because of a big Q3 turnaround and its new brands Onvo and Firefly. We're going to dive right in on how to make this thesis, which is already pretty compelling, into something truly institutional grade. The analysis starts off really strong. It lays out some serious financial evidence. We're talking record revenue of $3.06 billion, gross margins jumping up to 13.9%, and this is the big one, a shift to positive operating and free cash flow.
They absolutely are, and that's the thing. When you have such a solid foundation, with these undeniable structural improvements, the argument you build on top of it needs to be bulletproof.
Because the scrutiny just gets higher.
Exactly. The market starts paying very close attention. So here's the first big point. The persuasive power of this strong buy thesis can be, massively amplified by fully engaging with and just dismantling the most prominent bear arguments. That's how you really build confidence in this structural shift.
Right. I noticed the report deals with the recent stock dip by chalking it up to technicals. It's a classic sell the news event, low volume during a U.S. holiday.
Mm-hmm.
And it leans really heavily on that 530 price point as the, critical support level to watch.
And that's fine. I mean, that technical explanation is clean, it's simple, and for a short-term trader, it's probably enough. But we're talking about value investors here. For a sophisticated investor who's seen the insane volatility in Chinese EV stocks, relying on a technical floor just feels shallow.
It's not addressing the root cause of the skepticism.
Not at all. The market's worries aren't just about some light profit-taking. They're about these persistent fundamental fears that have haunted these stocks for years. The longevity of margins, the crazy competition in China, geopolitical risk, you name it.
So the weakness here isn't that the analysis is wrong, it's more that it's missing a huge opportunity. It gives a trading explanation when what's needed is fundamental reassurance.
You've nailed it. You're presenting these massive wins, that $3 billion in revenue, the 13.9% margin, but if you don't use those incredible numbers to defeat the structural fears, the reader might just assume they're temporary.
That they're just a blip.
Right, a brief truce in the price wars, not a real structural improvement in efficiency. If you're going to argue they're the paradigm shift, you have to prove the old problems are actually solved.
Okay, but let me push back a little. If the company just reported positive free cash flow, why do we need to dive into the weeds of geopolitics or market competition? Doesn't the cash flow sort of speak for itself?
It speaks volumes. It does. But the market is always worried about tomorrow. So the suggestion for improvement is to really integrate specific counterarguments. You need to show that the analysis has proactively considered and neutralized the entire bear case. You have to tell the investor why this time is different.
I see. So it's about transforming a great financial report into a truly resilient investment thesis. Let's get actionable then. How do we do that deep dive?
Okay, first, you have to analyze and rebut the risk of a new, unexpected, and frankly devastating round of price wars in the Chinese EV sector. The report has to prove unequivocally that the 13.9% gross margin is structurally defensible.
And what does structurally defensible look like in practice for a car company?
It means showing that margin comes from internal efficiencies. Things like a better localized battery supply chain, improved sourcing, manufacturing scale from their new factories, stuff like that. Not just from a competitor backing off for a quarter.
I see.
Like, are those battery swap stations generating enough recurring subscription revenue to act as a permanent buffer against hardware price cuts? You need to show why that margin stays at 13.9% or even goes higher, no matter what BYD or XPeng do next.
That definitely shifts the focus. It's not just NIO is making money now. It's NIO has built a moat around its profitability and will keep making money.
Precisely. And second, you need to provide a fundamental failsafe. Identify a bedrock data point, like the $5.9 billion of cash on hand, or that incredibly low price-to-sales ratio of 1.3x, and make that the anchor of the whole valuation thesis.
This is like the insurance policy for the argument?
It is. You have to explain why even if that technical $5.30 support level breaks, which, let's be honest, could easily happen in this market, the long-term case is still totally intact because of that deep intrinsic value. The reader needs to get that the PS ratio provides a margin of safety that a simple technical level never could. That's what turns a trade wreck into a real long-term value opportunity.
Excellent. Okay, shifting gears a bit, let's talk about the audience. The report does a really good job here. It defines its audience as value investors, growth traders. And it backs that up with a great valuation comp. The 1.3x PS for NIO versus Tesla's 6 to 8x, it sets up the value argument perfectly.
The foundation is superb, I agree. But the alignment, it kind of breaks down right at the end in the conclusion, which is exactly where you need it to be the strongest. To better align with that primary target, the value investors, the conclusion really needs to shift its emphasis away from short-term momentum triggers and back towards long-term intrinsic value.
I felt that tension too. The conclusion leans so heavily on the catalyst calendar. December deliveries, NIO Day, Q4 profitability guidance. And then it gives this very specific trading instruction, stop loss, close below $4.80.
Right.
It reads like a trading alert at the end of what's supposed to be a value thesis.
And that combination is the weakness. It undeniably frames the whole thesis as a short-term momentum trade. And while that's great for the growth traders, it could really confuse or even alienate the core value investor audience. They're looking for a margin of safety, a multi-year outlook, not a precise stop-loss trigger.
But wait, isn't a stop loss just good risk management? I mean, if you're a value investor trying to catch a falling knife in a volatile stock like this, don't you need that stop loss to manage risk, even if you're thinking long-term? Isn't advising prudence a good thing?
Advising prudence is always a good thing, absolutely. But the prudence needs to be structurally defined, not just mechanically. So the suggestion here is more about recalibrating the tone and the emphasis. It's about rebalancing the weight between the financials and the catalysts.
Use the financial data to anchor the value case.
Yes, exactly. Anchor it with a positive operating and free cash flow with that 1.3x PS ratio.
So you're saying we should frame the catalysts differently?
Precisely. The catalysts, like NIO Day or the delivery reports, they should be framed as the triggers for the market to finally re-rate this deep undervaluation. They aren't the core reason to buy the stock. The reason to buy is the intrinsic value gap. The deep value is your margin of safety, not a preset price limit on a chart.
That's a really crucial distinction. The analysis needs to speak the language of intrinsic value, using that PS multiple to convey the safety net. Okay, let's make that actionable.
First, structure the final verdict entirely around the massive discount implied by that 1.3x PS ratio. You can even highlight that it's a 50% discount compared to a peer like XPeng at 2.5x. Establish that undervaluation as the primary margin of safety argument. You want the reader thinking, wow, I'm buying $1 for 50 cents, not, okay, I need to set a limit order at $4.80.
And second, let's talk about the Q4 profitability guidance. Right now, it just feels like another date on the calendar.
It should be treated as a foundational shift for the company. The report needs to rephrase that discussion. Instead of a near-term spike trigger, emphasize it as the final structural confirmation that NIO has become a self-sustaining entity.
That it doesn't need external funding anymore.
Yes, this event structurally eliminates the long-term bankruptcy risk, which is the ultimate bear case, in a way that even the $5.9 billion cash buffer can only temporarily address. That speaks directly to the heart of long-term value creation and, frankly, solvency.
That elevates the guidance from just a quarterly data point to a major de-risking event for a value buyer that lands with a much bigger impact. Okay, let's turn to the core growth story now. The report makes a really strong case for future growth, highlighting these supercycle engines. Onvo, which was 43% of Q3 deliveries, and Firefly, the global play targeting Europe for under $30,000. This multi-brand strategy is clearly central to the whole bull case.
It is. And that transition from a single premium brand to a complex multi-tiered automotive group, that is the most exciting inflection point here. But that complexity is also the single biggest source of execution risk. The claim that Onvo and Firefly will drive this supercycle requires a much more thorough exploration of the execution and brand dilution risks that are just inherent in managing a complex three-tiered auto group.
The report really does present the success of Onvo and the launch of Firefly as just undisputed strengths. The tone almost implies all the hard work is done.
It totally glosses over the huge operational challenges. I mean, think about it. They're trying to manage a premium luxury brand, NIO, a mass-market competitor in Onvo going head-to-head with the Tesla Model Y, and a new budget export brand in Firefly. History is just littered with car companies that tried to do this and failed.
Yeah, you get sales cannibalization or you drain your resources.
It's a massive challenge. You know, if Onvo is a huge success, does that damage the premium feel of the NIO brand? Are they spreading their R&D too thin? That's the strategic question a sophisticated reader is going to be asking.
And if you don't answer it, they'll just assume the worst.
They will. Skepticism becomes the default. So the suggestion is to strengthen those growth projections by adding a dedicated section analyzing how NIO plans to manage this. How do they handle interbrand differentiation? How do they avoid cannibalization? Make that long-term projection feel more resilient.
Okay, let's give some examples to guide that, focusing on how they can articulate that differentiation strategy.
Right. First, for Firefly in Europe, you need to address the specific regulatory or competitive risks there. Explain in more detail how a sub-$30,000 price is actually robust enough to compete with established European rivals. It's not just about avoiding tariffs.
What's the secret sauce?
Right. What proprietary tech, maybe localized battery chemistry or specific design choices for European cities, allows it to undercut local players without feeling cheap?
That gives Firefly a real, defensible identity beyond just being an inexpensive import. It feels tailored.
It has to. And second, you need a clear firewall between NIO and Onvo. Provide a clear distinction between their target markets and technology, and it has to be more than just price. You have to explain how the huge success of the mass market brand Onvo will not pull crucial R&D or brand focus away from the higher margin premium NIO vehicles.
Is the battery swap network the main differentiator here? Like, are both brands fully compatible, or is there a tiered system?
You need to specify that. For instance, maybe the core NIO brand gets exclusive access to the most advanced self-driving features or the best battery tech for a 6-month window. That justifies the premium and protects the high-end brand. You have to show the operational strategy that stops the mass market from eroding the luxury one. So, to summarize this critique, the analysis report has a fantastic foundation. The financial progress is undeniable. But to maximize its impact, we've hit on 3 key areas. First, proactively dismantle the fundamental bear case, specifically on margin longevity and price wars, instead of just using technicals to explain the price dip.
Second, we need to refine the tone to align more with intrinsic value investing. That means decoupling the core thesis from short-term triggers like a $4.80 stop loss.
And finally, provide a much deeper risk assessment of that multi-brand growth strategy. You have to address brand differentiation and execution risk head-on to reassure readers that this supercycle growth won't just cannibalize itself or dilute the premium NIO brand.
Those are very actionable steps. So for the listener refining this work, it really boils down to using that 1.3x PS ratio as the structural safety net, not the 530 technical floor. Directly addressing margin erosion risks to prove the 13.9% margin is permanent. And finally, detailing a clear separation strategy for NIO, Onvo, and Firefly to kill any concerns about cannibalization. This is a very, very strong case that's just a few strategic refinements away from being truly elite, institutional-grade analysis.